So what does all of this mean, especially when it comes to the future path of rate hikes? Let's bring in Jean-François Perrault, Senior Vice President and Chief Economist at Scotiabank. Jean-François, the fact that there's a technical recession, is there a surprise to you?
I mean, it's not much of a surprise. We knew in the summer months that the economy had been slowing, as the governor indicated in that clip. But we also knew that the economy is being buffeted by, wildfires, floods, strikes. So the data for most of the summer months have been pretty muddled by kind of these one-off effects, which are all negative. So in that sense, it's not really a surprise that we had a soft period in the summer months, because it's a combination of those factors and the fact that, finally, those rate increases are starting to be felt pretty broadly across the economy.
So is this as bad as it gets? I mean, the recession obsession has been with us for a year. I mean, if it's confirmed when the actual data comes out that we were in a recession, can we just say, okay, we did it, we managed the slowdown, now we can return to growth? Or is there further declines in the offing for the Canadian economy?
Well, listen, I think we're still in the kind of early phases of the economic adjustment. Now, we're not of the view that we're going to have a hard recession, a stall, a soft landing, something along those lines. So, we'd agree with what the governor said. In fact, our most recent forecast is very much in line with what the governor said in terms of, pretty kind of sluggish economic activity the next few quarters, again, as the full impact of rate increases is felt through the economy. Now, I think the thing to keep in mind, one of the reasons we call these things technical recessions, so a couple of quarters of decline economic activity, is it's a pretty simplistic way to think about economic strength or weakness, and especially when you keep in mind that over the summer months, we've actually seen a pretty significant increase in employment. So even though the economy is kind of stalled, declined a little bit, and technically a recession, it's actually been a pretty strong job performance over that period of time. And that's really kind of the indications that you'd look for in terms of something that would be more major as a correction, right? So a slowdown in economic activity that's broad-based, not just due to some one-off factors. And of course, with that, some significant job layoffs, some job cuts, and increasing unemployment rate. We're not really seeing that now, and we expect to see some weakness in employment, but we're still in a world where there's a pretty significant amount of job vacancies.
Yeah, I was just going to bring that up. This has been kind of a job lossless recession, if I can invent that word. And I know we look at, unemployment as sort of a leading indicator of the economy. Might it turn out to be sort of lagging? Cutting a workforce, maybe because of the memories of COVID and how hard it was to get employees, maybe that's now the last line for businesses. Could we still see the unemployment rate continue to trend higher?
I mean, we definitely expect that. I mean, there's in fact a bit of a lagging relationship between economic activity and employment. So we are expecting a modest pickup of unemployment, half a percentage point or so in the next few quarters, which isn't really a big deal by historical standards, but of course is required if you're trying to slow the economy. But we expect that pickup in unemployment, to be reasonably minor given history, because of the point that you've indicated. We know that firms, by and large, are still concerned about job shortages. We're still, we know that firms have spent a tremendous amount of energy attracting and retaining workers over the last couple of years, and we know that that's probably leading them to hoard workers, to hold on to workers as long as they possibly can, and get rid of them only in the event that they really don't need them, because once workers are gone in this economy, they're going to be very difficult to get back.
The question for almost everybody out there is, okay, does this mean, despite what the Bank of Canada is signaling, we're probably done with rate hikes and we can start to pull forward when we're going to see the first rate cut?
I think that's pretty premature. Listen, the challenge the Bank of Canada has had in the last couple of meetings, and they've been very explicit about this. We've had indications for a while now that the economy is slowing. We haven't had really good indications that inflation is slowing. And that really is ultimately what's going to guide the Bank of Canada. So we might find ourselves in a bit of a technical recession, a bit of a pickup in unemployment. But if inflation doesn't come down with that, and that's kind of obviously how the Bank of Canada thinks about these things, but if inflation doesn't come down, then no, there's no way the Bank of Canada is going to be thinking about cutting anytime soon. And in fact, I think as the governor has been pretty clear over the last several communications of his, if inflation does not cooperate, if it doesn't follow the economy, we might be in for higher rates in the next few decisions. So actually, we think about rates very much as, or risks around rates is very much tilted to the upside. Much more likely that rates rise in the next 4 or 5 months than to see them cut.
So let's hold that view and marry it with the growing concern of what is coming for Canadian households with the number of mortgages that are set to come due, to be up for renewal in the next 3 years. Is this a perfect storm for Canadians and for the economy, one in which like only low rates can kind of solve?
Well, I mean, we know rates are definitely going to come down, right? It's just a matter of when that happens. Now, we happen to think that's going to be roughly around middle of next year. So there will be relief for Canadians as kind of the cycle progresses. So we're confident that's going to happen. Now, is it going to be early next year, late next year? We'll see. But that is definitely going to be, there will be a different kind of rate environment when Canadians, reset their mortgages next year, the year after that, and a couple of years down the line. Now, the reality remains that, of course, for Canadians that are renewing their rates the next couple, 3 years, they will almost certainly renew rates at a higher rate than what was contracted at. And that will represent a payment shock, of course, but that's partly how monetary policy works. They're long and variable lags. So rate increases today or 6 months ago, feed through the economy over the next year and a half or two. So that's not unusual, in terms of how monetary policy works. And it's not unusual to have these lagging and lasting impacts of higher rates. What's unusual is the fact that, we're going from, very low mortgage rates to, kind of normal-ish by historical standards. And of course, what's also abnormal is the fact that house values are extremely high by historical standards. So mortgage, the typical mortgage is significantly more expensive than it was 5 years ago or 10 years ago.
All right.